For me, the primary thing that sticks out were actually all the wildfires that we saw this year. The smoke was visible from the fires happening in Quebec, right here in Toronto. And it seemed, at one point it seemed as though the entire country was on fire. Our economy proved to be a little stronger than anticipated in Q2, prompting the Bank of Canada policy rate to tick upwards to 4.75% after having held steady at 4.5% throughout Q1. It's now sitting at 5% in real time at the end of Q3 and seemingly having an impact on slowing down some economic activity. The wildfire situation did have an economic impact in Q2, and that, coupled with other weather events, caused profits of businesses to fall by 2%. And I realize we're actually not on the right slide, but that's okay. So I'm gonna push to audience. Do you guys see what I'm talking about now? Okay. So what I'm going to do is, I'm not repeating all of that. No. That's just, you'll take my word for it. I'm going to push to the audience, the next slide. Okay, so looking at wages and employment rates, the cost of labor, thanks for the thumbs up. The cost of labor continued to rise and job vacancies continue to fall. The average hourly wage now sits at $25.40. And in terms of job vacancies, though, we're still not near those pre-pandemic levels. The unemployment rate sat at 4.5% by the end of the quarter. And you can see that one, right? Yes, okay. So now let's dig into this quarter's credit trends. In the second quarter, what we see are three key themes emerging. So first, we'll see the impact of the continued interest rate hikes having an effect on commercial lending. As well, like we began to see in the last quarter, businesses are relying more on lines of credit and credit cards over installment loans. And lastly, financial stress is rising more as businesses start to miss payments. Before we dig in, though, I'd like to take a minute to do a quick poll. Given that we're mid-September and the end of the year is right around the corner, one thing that is looming on the horizon for Canadian businesses is the COVID relief program's repayment deadline. So with that in mind, let's get your thoughts on the following. To what extent do you agree with this statement? The December 31st, 2023 deadline for the repayment of government-backed business loans comes at a time of economic stress for Canadian businesses. Do you A, strongly agree, B, agree, C, I don't know, D, I disagree, or E, I strongly disagree? So if you could all just take a couple of seconds to plug in your thoughts. I know we typically get a wide variety of audience members joining us in various sectors with various focus. So it would be kind of cool to see what you all think about that. So I guess we'll hit the next button and see where we go. Aha, yeah, cool. So strongly to actually agree. So less passionate about this, but that's good. So we'll see how, thank you very much for your thoughts on that front. Okay, so let's look at the lending landscape in terms of balances, credit usage, and new business starts. The average business debt that has been carried has really increased this quarter, both on a year-over-year and also on a quarter-over-quarter basis. Businesses now have an average balance of nearly 45,000. That's a 22% jump since the same time last year, and 0.5% since, 14.5% since last quarter. Quite a significant increase in balance this time around. Insolvencies have increased by nearly 40% compared to Q2 2022, and by 2% since last quarter. The delinquency rate sits at nearly 5%, 4.9% this quarter, which is an increase of 5.7% versus last year and 3.3% versus last quarter. And finally, inquiries are also up by 5.5% year over year and 6% versus last quarter. Inquiries being an indicator of increased credit-seeking behavior. And for me, these numbers really paint a picture of an overall increase in strain amongst businesses this quarter. Okay, breaking down the balances across the financial trade credit facilities. In this slide, in the graph, what we're looking at in the current quarter on the far right-hand side, in the middle stack bar, it's the same quarter last year in 2022. And then the first stack bar there on the far left, that's the second quarter of 2020. So kind of pre-pandemic figures. You're looking at the share of balances across installment loans in the green, lines of credit in red, and credit card balances are in the blue. We know that balances have increased significantly, and what you're seeing here is the shift in credit usage. The surge of installment loan balances that we saw in 2022 has returned to roughly where the share was in 2020, but there has been double-digit growth of balances for both lines of credit and credit cards. The share of balances is returning to where things were pre-pandemic, actually, but the concern now would be the change in interest rates since that period of time. Okay, now let's look at utilization. So utilization is a measure of how much credit that is available to a business is being used. So balances compared to limits. Prior to the pandemic, businesses actually had much higher utilization rates, even compared to now. They dropped significantly by the start of 2022, and we're now seeing them begin to head upwards again. On lines of credit, we saw balances grow by 21% and the number of new accounts by 4.7%. So businesses are leveraging existing credit products more so than opening new lines of credit. On the other hand, with credit cards, balances grew 22.6% and the number of accounts increased nearly 18%. So increases in card utilization is actually being slightly masked by, a bit by higher originations. Okay, so new business openings. Business openings are returning to a period of growth again after that extended period of contraction that we had seen. And for the first time since 2020, we actually see that once again, there's a summer spike in new business openings, something that we actually have not seen for quite a few years now. So that is great to see. Keeping in mind that these numbers are reflective of Q2 of this year, there is double-digit growth clear across the country on a year-over-year basis. Again, very promising results. When we compare that to how things were prior to the pandemic, unsurprisingly, the growth isn't as strong at a national level. The Western regions report declines in terms of new business openings compared to 2020, while Ontario and Quebec are both reporting strong growth. Quebec in particular saw more starts in Q3 of 2020 rather than Q2 of that year, which is why growth is high in that province in particular. And Q2 is typically the quarter where we see stronger new business starts. And if I remember correctly, Quebec locked down sooner in 2020 than the other provinces did, which might be also contributing to that 52% growth rate that we're seeing there on the table on your right-hand side. Okay. So now let's examine the second theme that has emerged this quarter, and that is an increase in more businesses seeking new credit. Okay, on this slide, what we're looking at is the number of inquiries by province as indexed to the inquiry levels seen prior to COVID. And the table on the right is the growth rate for the inquiries on a year-over-year and current versus pre-COVID basis. Inquiries is a measure of credit demand, and as you can see there in the line graph, the growth in credit demand when rates were really low and prior to everything shutting down by Q2 2020. And then once everything locked down, we see that big drop, which was sustained throughout the second half of 2022. Now in 2023, we're seeing demand growing again. That trajectory is starting to spike upwards, and we're beginning to get back to those pre-COVID levels. Regionally, all provinces are reporting an increased demand for credit versus this time last year, with Ontario having the greatest increase in inquiries at 9%. Okay, here we're looking at the number of new industrial trades that have been reported since the last quarter. And industrial trades, again, those are the supplier trades, not the financial or banking ones. And we'll look at financial trades on the next slide. But here you can see very healthy growth of new supplier trades. Overall, we've seen an increase of 6.7%, which is largely driven by businesses that are 5+ years old. And that first column in the table on your left being the age of the files that these trades are reported on. And as we do typically see, it's those older, more mature businesses that are opening new supplier accounts to a much larger extent. On the right-hand side of your screen, we're looking at the split between the score bands of the commercial delinquency score for new originations within industrial trades. Lenders within industrial trades are exhibiting a bit more caution now when it comes to the risk profile of new accounts. We had been seeing higher risk bands grow in proportion during 2022 when the economy was opening back up and industry wanted to get back to business, but now it's returning to a lower risk share for new account openings, kind of signaling a cautious approach to lending from industry. Growth that we saw on the supplier side. On the banking side, new account openings are down 3.7% annually. These are the financial trades opened by businesses such as loans, lines of credit, and credit cards. Quite a sharp contrast here, even with those businesses 5+ years old, which saw a decline of 13% compared to the growth that we saw on the supplier side, which was up nearly 12%. The decline here is likely a result of those climbing interest rates that we've all been seeing. The other interesting change here is the score band splits. Here we're looking at the financial trade delinquency score bands. And, we had been seeing a heavier weighting of new accounts within the lower risk segments for quite a while. And now we're seeing growth within the higher risk bands increasing a little bit more. So the caution that we had been seeing on the banking side is easing up just a little bit. Okay, now turning our attention to the major metropolitan areas in our great country. On the left-hand side of your screen are the new accounts opened within the financial trade segment, and on the right are those supplier trades. Within the financial trades, each major city, with the exception of Montreal, actually reported a quarterly increase. And on the supplier side, the growth that Toronto had been experiencing has started to soften this quarter, along with all the other major cities. Okay, looking at new accounts by credit type. In this slide, we have lines of credit on the far left, installment loans in the middle of your screen, and credit cards on the right. Then in the stack bars, it's each quarter from Q1 of each year at the bottom in red up to Q4 in gray. Okay, and so looking at lines of credit, we saw growth in 2022 overall, and Q1 of 2023 proved strong in terms of new accounts compared to the last 2 years. But looking at loans and cards, we almost see like an inverse relationship happening there. The number of installment loans declined year over year, very likely due to the combination of government relief CEBA loans and just general COVID restrictions. It's important to note too that the CEBA loans aren't actually captured in this data. And so inversely, the number of new credit cards has grown quite significantly since 2020. The first quarter of this year looked like that might be stabilizing now, though, as it's slightly on par with Q1 of 2022. So we'll see how that plays out for the remainder of the year. And so with that, I think might be a good time for our second polling question, checking to make sure you're all still with me. Okay, so second polling question, to what extent do you all agree with this statement? The December 31st, 2023 deadline for repayment of the government-backed business loans will cause financial stress for Canadian businesses. So to what degree do you agree that it will cause financial stress for Canadian businesses? Do you strongly agree, not so sure, disagree, or you strongly disagree? And let's see. This is where there's awkward silence while we wait for everyone to click their responses and I try to fill the air. I never know what to say during this time. Get clicking and let us know what you think. And let's see if we've got the results. Do we have the results in? There we go. Okay, so yes, once again. So there is a sentiment and a couple of people out there strongly disagree, but generally speaking, yeah, we're kind of feeling like the looming deadline at this point in time, that's just gonna cause additional hardship. So yeah, thank you very much for your participation in our poll. It's not scientific at all, but it's interesting. Okay, so let's now look at delinquencies. Awesome. Okay, so in terms of the delinquency rates for the early stage or those 30-day delinquencies, we see the typical drop in Q2 that we do normally actually see. And there has been a slight rise in delinquencies over the past year, but things are still very much below the pre-pandemic levels. So that's good news. When it comes to the roll rates, which is a measure of what percentage of accounts go from 30 to 60 days and from 60 to 90 days past due, we see that things are starting to settle down a little bit from the increase that we'd seen throughout last year. In fact, movement to those very late stage delinquencies dropped this past quarter. And then once again here, we're breaking down the delinquency rates by financial trade type. So installment loans, if you can't read the font size on your screen, because I can't, that's on the left. Lines of credit are in the middle and cards are on the right. In the previous slide, we saw the delinquency rates growing at 2 to 5% overall. And when you break it down by product, you can see it's largely driven by installment loans and lines of credit. Installment loans are displaying a steady quarter-over-quarter increase since last year. And lines of credit, while delinquencies dropped a bit in Q4, they are on the rise too. Interestingly, card delinquency rates haven't changed that much. And that is likely a factor of the significant growth of new card originations that we saw. So definitely something for lenders to keep their eyes on, because that could be a little bit masked. Okay, so now we're looking at the delinquency rates amongst the industrial trades. Compared to last quarter, the delinquency rate has increased within the supplier trade segment. Even on a year-over-year basis, delinquencies have increased, particularly the late-stage delinquencies. But again, overall, things are still lower than we were seeing prior to COVID, suggesting that some businesses that were really struggling back then are probably out of the mix today. But of those that are still in the mix, the strain is beginning to show. Rates seem to be headed back to those pre-pandemic levels. Same thing when we look at the roll rates, you can see a big uptick there in the second quarter of this year as those 30 plus days turn into 60. And likewise, the 60 plus day delinquencies turn into 90 plus. And in fact, roll rates are now higher than they had been. So a sign that businesses are struggling to make payments on time. And on a quarter-over-quarter basis, nearly every single sector is reporting around a 2% delinquency rate increase. Year over year, things are a little more varied, but the financial and real estate segment really showed a pronounced increase of just over 10%. Generally speaking, it's a sea of red across the board. No one industry sector in particular appears to be doing better than the others right now. And then finally, let's now look at the bankruptcy rates. We're now starting to see a rise in bankruptcies, whereas there had been a sustained period of relative stability during the lockdowns. But you see there in the last few months on this graph, a gradual increase in bankruptcies. Proposals have remained fairly flat this year, though. And where is that coming from regionally? Well, I suppose given the wildfire situation out west, it's not entirely unsurprising that BC reported the strongest increase in bankruptcies. But Quebec is reporting both a quarter-over-quarter and a year-over-year increase in bankruptcies. And with that, let's recap this quarter's highlights. Okay, so this quarter, we saw businesses seeking more credit amidst inflationary pressure. Older, more established businesses were the primary drivers of new trade originations. Credit card demand remained strong, with 62% of all new financial trade originations being from cards. And we saw a nice trend reversal with a return to new business starts in Q2, with Ontario and Quebec reporting stronger growth than other provinces in terms of new business openings since the start of the pandemic. Financial stress was growing this quarter. The average debt carried by businesses increased to 44.7 thousand, and while still lower than pre-pandemic levels, we started to see industrial trade delinquencies fast approaching the 2019 levels. As well, more businesses have started to miss payments on their loans and lines of credit this period than they did 12 months ago. And finally, the increasing cost of business could lead to more insolvencies as we head into the second half of the year. Businesses will continue to be impacted by high inflation and higher cost of borrowing, and we're seeing higher demand for credit already. So given the year that we've had weather-wise, businesses impacted by natural disasters could take longer to recover in this economy or fail to survive at all. And so with that, let's get to the panel portion of our session today. So I'm very excited to introduce two very distinguished guests that are joining us all today. Joining me are Kelly Higginson, President and CEO of Restaurants Canada, and Beth Potter, President and CEO of Tourism Industry Association of Canada. Kelly began her career at the Keg Restaurants, but eventually moved into the independent sector, successfully opening the iconic financial district restaurant Key, modern Japanese and bar. She commanded a variety of positions within the restaurant industry before joining Restaurants Canada. And Beth was recently named one of the top 50 women in travel by the Global Business Travel Association. Beth has over 35 years of diversified provincial and national association experience and close to 20 years in the tourism sector. It's a true pleasure to have both these ladies with us here today. So ladies, thank you both for joining me. Kelly, I wonder if you would mind introducing yourself and also maybe give us a bit of a background on Restaurants Canada and the work that you all do there.
Sure, thank you. Well, as Sinead was saying, Kelly Higginson, President and CEO with Restaurants Canada. I've spent over 25, we'll leave it at that, years in the hospitality food service industry and sat on the board of Restaurants Canada before joining the team. Restaurants Canada is a not-for-profit trade association that represents over 60,000 food service businesses across the country, including bars, restaurants, caterers, and institutions. Our work really is to connect members from coast to coast through service, research, and advocacy. And our goal and mandate is creating a thriving and vibrant food service industry. Really what I guess we're most proud of, and a lot of people don't know, is that we are the 4th largest private employer in Canada, which makes up over 1 million jobs. And we really are an economic engine in Canada with generating $100 billion in sales a year.
Wow. That's awesome. Thank you. And Beth, would you mind taking a second to introduce yourself as well and also tell us a bit about the Tourism Industry Association of Canada?
My pleasure. Thanks so much, Sinead. I think, Sinead, you gave me a great introduction. Let me tell you a little bit about TIAC, though. We are the national not-for-profit sector association representing all forms of tourism and travel within the country. And that means that we are speaking on behalf of about 250,000 businesses every day. Prior to the pandemic, the industry was a $105 billion a year industry. We employed 2 million Canadians, and we represented 2% of the GDP. We can talk a little bit about what happened during the pandemic, and that was catastrophe. Initially, we saw a reduction of half of our income coming in as far as retail or spending into the country, but also half the jobs were out the door and gone within a matter of weeks. And, tourism is often thought of only in certain terms. People think about tourism, they think about the vacation they're going on. They think about hotels, they think about planes, they think about eating in a restaurant, but it's much more than that. The travel and tourism sector is made up of all kinds of businesses. So let me just give you a few examples so that, when we're talking about our industry, you can maybe understand a little bit more about the broad scope of the sector. When we talk about food and beverage services, we're not just talking about restaurants, we're talking about wineries, we're talking about the food and beverage that you have at a conference. We're talking about those local producers and all the businesses along the food and culinary value chain. When we talk about accommodation, it's not just hotels, it's resorts, it's camping, it's Airbnb. When we talk about recreation and entertainment, we're talking about things like boating and festivals and events and live performance. We're talking about attractions like museums and galleries. When we talk about transportation, sure, we're talking about planes, but we're also talking about trains and cars and buses and boats. And when I say boats, I mean cruise ships. And then finally, travel services. A lot of us do our own travel booking these days, but we all use different engines. And so engines like Expedia, any kind of online travel platform, as well as the direct to buy platforms whether it's through your favorite hotel chain, your car rental chain, etc., or travel agents. There still are travel agents out there, and they do a very important job for us. So that just gives you a good sense of kind of what makes up the travel and tourism industry here in Canada.
That's extremely impressive. It's really broad when you put it in those terms. Like you wouldn't really, you kind of know it, but you don't really think about it until it's kind of laid out like that. Thank you for that. So I thank both of you for coming in to share your insights with us today. And as we saw in the quarterly overview, businesses have been through a lot these last few years. And the first half of 2023 has been no exception. So even though we're open for business again, the supply chain is sort of recovered. New challenges have come along, putting strain on a recovering economy. The government relief loans that were originally intended to be paid back by the end of this year have already been extended once. And it's a little uncertain whether or not there might be a second extension. We know that certainly the recovery has challenges too, which has added new financial and logistical strain to businesses. And from what I've read, it looks like only a very small percentage of those loans have actually been repaid fully, and therefore able to take advantage of the loan forgiveness portion. And so before we get into my next line of questions for each of you, I guess I'm going to do my last polling question and just take a quick minute to ask our audience, okay, how does the audience feel about the deadline of the end of this year? Do you think the government should be extending the payment deadline? So A, do we want to leave it as it is for the end of the year? B, the deadline for repayment should be extended by another year. C, the deadline for repayment should be extended by more than a year. Or D, the loan should be forgiven altogether. So not sure how government would feel about that, but or the banks for that matter. But anyways, let's let's see what our audience thinks. Let's see. Give this one another awkward pause minute for some of those answers to come in. So what do you think the government should do about the repayment of the government-backed business loans? I see the ticker moving. So give it another second and maybe we'll move to the results. Yeah, okay, so leave the repayment deadline as it is. 40% of our audience said that. And almost 50% said that it should be extended by another year. And 3% said it should be written off altogether. Okay, so interesting. Looks like most of you are in favor for not writing those loans. Okay, so Kelly, maybe we can start the discussion with you. Can you tell us how important the restaurant industry is to Canadian economy and its communities?
Sure. And I guess I do want to just flip back to the last poll that you did. And I know Beth and I talk about this a lot in the media to make sure that everyone is clear. We are not, as associations, asking for handouts or more money. We are asking for more time. So I just want to make sure that we cover that very quickly before we jump into anything else, for sure. But as I said, you know, we are a $100 billion industry. We are projecting and forecasting a 10% increase over the next year to those numbers. So these are pretty significant numbers for the Canadian economy. But I also think more importantly, we look at the employment rate being the fourth largest private employer. I think we also take a look at the significant impact that we have on communities across the country, small, medium-sized towns and cities across the country's main streets and downtown cores. They all have bricks and mortars of restaurants. We serve 22 million guests a day. So we are an important part of a Canadian's, not just their weekly routine, we're talking about their daily routine. So when we look at all of that and we start talking about investment and the importance in the economy, and in Canada, I mean, the audience is there, really. I think if we take a look at the challenges that we're feeling right now and the headwinds, that there's been a lot of headwinds in the last 4 years, that's where we come to. We just want a little more time to try and recover from what this very resourceful, I will say, industry went through. I mean, the fact that we are still standing is pretty impressive given what the industry went through. And, you know, we do obviously have these loans and some of the other subsidies provided by the government and some really great work with suppliers and landlords across the country. But I think since the end of the official pandemic, there's been nothing but more headwinds hitting them at light speed. So taking a look at that, while we are struggling, we also have a lot to offer our communities and the economy, especially when it comes to the employment that we offer the country. And I think the part of it also is what we bring to people's day-to-day lives.
Yeah, completely agree. And Beth, based on the data that you have seen and from what you're hearing from your members, what is the current environment for small, medium businesses in the Canadian tourism industry?
Well, you know, one of the things I'll say is that Canadians love to travel, and they, you know, the domestic traveler certainly has come back, and because of that, a lot of businesses have been able to carry on post-pandemic. But what they haven't been able to do yet is to make up the lost revenue that they missed during those pandemic years when we were all asked to stay home. And so that is in fact one of the biggest challenges. And because of that, we're seeing the debt rates as high as they are. So we did do a survey within our industry, and we found that really 55% of tourism sector businesses felt that they were going to be really challenged to make debt repayment. And this is specific to the Government of Canada support lines during the pandemic. So we're talking about CEBA, we're talking about the Regional Recovery and Relief Program, and the Highly Affected Sector Credit Availability Program. They're busy paying off other debts, and they're busy making sure that they're keeping their supply chain paid as well. So this is part and parcel of their big challenge. And the other thing that I want to remind everybody is, you know, making up the revenue that you missed is a little bit more challenging in our industry. we are a little bit perishable when you think about it. If you don't sell a hotel room today, you can't sell it twice tomorrow to make up for the lost revenue. And it's the same with an event ticket. It's the same with restaurant meals. You only have so much capacity every day. And so this is the challenge that the industry has been facing. And then on top of that, those headwinds that Kelly mentioned, the other things that have been impacting our industry, wildfires and extreme weather events. Those events, impact everybody within a certain region, but the media coverage has not helped us from a brand reputation standpoint. We want to say to the world that Canada is open for visitation. We're open for business travel. We're not closed, and the wildfires are not consuming us from coast to coast to coast.
Yeah, that's very true. Yeah. So given those challenges and maybe some others that both of your industries are facing, would you both care to share your thoughts on what those loan repayments might kind of how they might impact Canadian businesses? Are you guys thinking about that and in terms of real time effect on businesses and restaurants and tourism specifically? Maybe we'll start with Kelly.
Sure. Yes, I can guarantee that it definitely keeps us up at night. All of us in the association and the industry, it's definitely weighing heavily on us. We have seen an increase in bankruptcies for the first 5 months of this year in our industry of 89%. And these kind of numbers are really concerning. And part of the issue is the lack of predictability that we have had over the last 3 to 4 years. So I don't want to focus on the doom and gloom because this is still a very viable business. As I said, The audience is there, 22 million customers a day. That's pretty big, $100 billion industry. What we have to do now is to make it more profitable again. So while we've had this top line growth in sales, we need to find how to make it more profitable and bring it back down to the bottom line. Beth was already talking a lot about the debt that occurred during the pandemic and then the reopening period. As soon as we reopened, we were hit with these high food costs that all of us have been experiencing in our own lives, and it's just been constant for our industry. The interest rates increasing, other inflationary increases. So they haven't been able to catch up from that. If the government does not act and extend these terms, restaurants will close. Communities will lose their local restaurant. Seniors might lose their Wednesday night lunch spot. I mean, these are really important pieces of the social fabric of the country. They're very important to our health and mental well-being. They're also very important to the main streets. If we take a look at the bricks and mortars that have been closed up, it also has a very big impact to the vibrancy of our communities and also the employment of our communities. So they're reaching a point now where they're having to take on more debt, more liability just to continue to get by. I think what we want to see and what we want to talk about is how restaurants, they don't want to be a minimum wage employer. And there's this myth that they want to have, only part-time staff, they want to be a minimum wage employer. And that's simply just not true. They want stability. Being in the industry for a number of years, one of the top important things in our business model was being able to offer benefits to our employees, to offer that stability and competitive for talent. So, we've seen a jump in wages with more than 90% of our employers raising their wages over the last 4 years. We've got an increase in employers offering benefits of 35%. So these are all really important parts, and we want to be able to take time to pay back these loans so we can reinvest in our businesses and make them more viable again, make them more profitable again. So this is stuff we're looking at in investing in equipment upgrades for automation. We're talking about, equipment upgrades to make it more efficient, and we're talking about investing in our employees.
Yeah, that's awesome. And Beth, do you have anything else you want to add from the tourism perspective to that?
Well, first of all, I mean, everything that Kelly said applies to tourism businesses across the spectrum. What I will say is that, there are those myths out there that tourism businesses are only part-time or they're only seasonal. And I can tell you right now that the industry has been working very hard to make Canada a year-round destination. And the number of jobs that are now full-time, full year, has increased, and that the number of careers that are available within the tourism industry are significant. The other thing I'll just say too is that, while our industry is looking for a little bit of relief as far as, the deadline for those CEBA payments to be repaid, at the same time, they're doing everything they can to invest into their business, whether it's, continuing to mentor young workers, continuing to engage in the communities that they're established in. But they're 100% in. And so, and these are some of the most passionate people that you'll ever meet. And I'll just remind too, folks, that so many of us had our start, our first jobs in the tourism and travel sector. It's that first job, it's that first on-the-job training, it's that first time you've got to listen to somebody who's not a teacher or a parent. It's the first time that you are, accountable for your actions in a way that is more meaningful to your life. And the skills that you get when you work in our industry are lifelong skills. They are people skills. They are transferable skills to any career out there. So, it's an incredibly valuable sector. We employ, 2 million Canadians prior to the pandemic. We're working our way back to that now. And I think that it's a sector that is sometimes misunderstood. And I hope that today's conversation has helped to shed some light on some of those misconceptions.
That's great. Yeah, that's all very, very true. Very good points. Okay, I would say last question for both of you. Given all of the challenges that have been facing the restaurant and tourism industries, are you both hopeful about the future? Kelly, we'll start with you, and then Beth.
Absolutely. I mean, as I said, the audience is there. This is a very strong industry. We are resourceful and agile and maneuvered through such unprecedented, unique circumstances. And I think that's something else that we really want to express to people is these aren't operators who don't know how to run a business. This was a very unprecedented event. And since the unprecedented event that we talk about, it has been nothing but more unprecedented circumstances in the economy. So, we are really hoping that we can get the industry the extension on CEBA, so to give them a little bit more time to protect that forgivable portion of the loan. And we are going to work very closely with government to recognize the challenges that small and medium-sized businesses face, and we must continue to work in creating a viable business environment for the industry.
Yeah. And Beth, are you?
I would echo what Kelly said around, giving businesses, the time, just a little bit of breathing room. These are the most resilient people I know. They are bonded as an industry. I mean, they've come through this horrible experience together. They are passionate about what they do, and so and they help tell the cultural story of our country. And so I think it's really important that we continue to find ways to work with the industry to support them in their recovery. We're not there yet. I'll just tell you this, that we are about 80% of the way back to where we were in 2019. And so we've got a ways to go yet, but we are coming back for sure.
Awesome. Okay, thank you both. I think we have 10 minutes left. And so with that, I think we probably have time for some questions that Jordan, you're going to post it in the chat. Okay, so I'm going to try and work because I'm actually working from Stephen's computer right now. And so let me see if I can manage to figure this out, and if maybe I have to scroll down. Do I have to scroll down?
Yeah.
I'm not sure where to find these questions in this chat, so maybe I'm just, oh, hold on. Oh, I think I found them. Hang on. There we go. Okay, I have a question to Kelly and Beth. If you can share what sort of steps have been taken by industry to decrease carbon footprint and landfills, and how they have impacted the members in terms of their operational cost and bottom line, and what sort of regulations their industry is facing, which is resulting in higher cost and impacting business growth. I'm not sure which one of you would like to maybe tackle that one.
Well, I mean, I can certainly jump in. I will just say that sustainable and regenerative tourism is certainly one of the main pillars of our industry and has been for quite some time. Not just here at home, but also globally. We're looking at ways to decrease the carbon footprint by using better processes within our own businesses. So if you check into a hotel, you'll see a hotel follows a Green Key program. A Green Key program analyzes all of the processes within a hotel that shows how they're using less resources like water, how they're using less energy, and how they're reducing their carbon footprint. And it's an audited program. We are working together, coming together and doing things, learning from each other. There's an annual event that many go to and participate in that specifically tackles these issues step by step. And there's a lot of work right now being done on helping businesses come up with an action plan for the next 10 years that will allow them to really understand how the sustainable development goals relate to their business and what they can do within their own business plans to align with those SDGs and make sure that they've got the tools and the resources in which to engage their team and really create capacity for change. So there's a lot being done. I know that Kelly can probably speak to some of the more kind of tactical examples, but I can tell you from our perspective, it's that ongoing conversation and ongoing work across all of the suite of sectors that make up the travel and tourism industry.
Great, thank you. Kelly, is there anything you want to add to that before we get to the next question?
I certainly agree with everything that Beth was saying, and this is a big conversation all the time. We're actually hosting a quick service restaurant sustainability working group session tomorrow at our offices, and this is a constant conversation. I'm quite proud of where our sector has come. I look at a lot of the innovation in some of the bigger chains and what they have done in a very short period of time. I think about when I was in operations, if 4 years ago we thought that you couldn't find a plastic straw to save your life at this point, I think it's really great the work that's been done, and I think some of the alternatives that our industry have been leading with has been incredible to see. So as Beth was saying, it's now sharing best practices. It's working closely with the government. We are working towards having conversations with the government to have a more scaled and harmonized approach. It's very fractured across the country, so that's one of the biggest challenges for our industry. Every province and municipality seems to be going in their own direction. So we would like to see the federal government take some leadership in that and to have some harmonization across the country. And we'd like to see a scaled approach so that we can have suppliers and manufacturers catch up so that there isn't the supply chain issues, and to start evening out some of the costs in the alternative packaging for our industry. But all in all, I think it's top of mind for all of our members, and it's a constant conversation, and it's not something that any of them are fighting against. They know it's important for the for Canada. They know it's really important as well for their guests. So
great. There's kind of two questions in here that maybe I'll bundle together before we wrap up. And the question is regards to, is there a particular reason why BC experienced significantly more bankruptcies than the rest of the provinces? And also, do you think that there will be an increase in businesses going into receivership or bankruptcy during the fourth quarter? I don't know who would like to field that one first.
Well, I mean, I can tell you right now that BC certainly got hit incredibly hard. It was the first wave of the pandemic hit there first. They are highly reliant on visitors from the Asian community, the Asian countries, and they are also highly reliant on the cruise line industry. And that got shut down completely, and nobody was coming or going. So, lots of reasons there tied to the pandemic. And then, of course, this past summer, the last couple of summers, we've had some extreme weather events and wildfires that have certainly kept tourists away from the province, and that is certainly having a huge impact. So these are all kind of cumulative reasons that could lead to BC having a higher bankruptcy rate than other provinces.
Yeah, I have to agree with everything that Beth has just said. I mean, it's been a really challenging couple of years out there coming out of the pandemic, but they were open as well, much more. We actually, one of the restaurants, the company I was with at the time, they were open a lot earlier than a lot of the other provinces. So they lost some of the subsidies very quickly, and much earlier than the borders were open, that cruise lines were back. And then they went into, as Beth was saying, last year was very challenging with forest fires. And then we know what's happened this year. So.
Yeah, it's been quite the storm, so to speak.
And to the second part, sorry, Sinead, but to the second part of that question around, what does the fourth quarter look like? Time will tell. We have had a good domestic travel season this summer. Our international numbers are not back yet, so we have to see how that plays out for the industry. Business travel is not back the way it was prior to the pandemic, so we'll have to see how that impacts. And then we'll also have to see whether or not the government hears what we're asking for, and to see if there's any kind of movement on these repayment deadlines.
Yeah, I think that deadline is going to be really key in our last quarter of the year. So
we'll all stay tuned and keenly watching. Well, ladies, thank you both very, very much for joining me today. What a wealth of knowledge you both brought to your regarding your industries. Very generous of you to share your insights with us. I learned so much, and I'm sure that our audience did as well, that they'll have some great nuggets to take with them as we head into the fourth quarter. I also like to thank our audience for joining us today. And if you liked what you saw, and you have an interest in learning more about fraud, just want to remind everyone that tomorrow my esteemed colleague Cheryl Prince will be leading the Fraud Trends and Economic Insights webinar, and I believe there's a registration link on your screen on the right-hand side. So please feel free to sign up for that and join us tomorrow. If you'd like to share today's session with a friend or a colleague that might have missed it, a link to the recording will be sent out, I think, in the next 24 hours. And lastly, thank you to the webinar production team, Stephen, Jordan, Paula, Sandra, Bala, Swarnama, and Robert. And thank you all once again for joining me. I appreciate it. And I will see you next time, and have a wonderful rest of your day.